Welcome to the deep dive. We are so thrilled you're joining us today.
Yeah, thanks for hanging out with us.
So if you've logged into a banking app or checked your email or really even just opened your mailbox at any point in 2026,
Yeah.
you have probably been hit with the exact same heavily marketed financial pitch.
Oh, absolutely. You really cannot escape the advertising for these right now.
Right. Lenders are aggressively pushing a product that promises to turn the roof over your head into into a massive, immediate pile of cash.
Yeah, the pitch is always some variation of, you're sitting on a gold mine. Unlock your wealth today. It's designed to sound incredibly empowering.
It really is. And that is exactly why we are dedicating today's deep dive to a massive investigative piece that was recently published by the Daily Fiscal.
Right. The piece titled The HELOC Trap: Why Tapping Home Equity in 2026 Could Backfire.
Exactly. We're talking about the home equity line of credit, or the HELC. But before we get into the historical rate charts and, the hidden fine print, I want to ask you, the listener, a very direct question.
This is a good one.
If your bank called you this afternoon, offering you a $75,000 line of credit secured by your home with funds available by tomorrow morning, would you take it?
It is a genuinely tough question to answer, especially when you consider how much home values inflated over the last handful of years.
Right.
A lot of people feel like they won the real estate lottery on paper, and they want to put those winnings to use.
Okay, let's unpack this. Because what looks like an incredibly easy financial win on the surface is actually layered with complex economic mechanisms.
Yeah, and my goal today is to synthesize the data from this investigation and make sure we are looking out for your bottom line. The marketing materials for HELOs are incredibly polished and persuasive.
They really are. And here's what that means. We are going to take a data-focused look at what happens when you sign that paperwork.
Right, because the reality of taking on a variable rate debt secured by your primary residence requires a very careful, clear-eyed look at the underlying math. We need to cut through the sales pitch.
To do that effectively, we shouldn't just speak in abstract financial concepts. Let's ground this in reality.
Story time.
Exactly. The investigation highlights a specific suburban Atlanta homeowner, and their situation perfectly illustrates the mechanics of this market. So picture this. It's 2019. This homeowner purchases a property for $310,000.
Okay.
Fast forward just 3 years to 2022, the housing market has completely surged, and suddenly that exact same home appraises at $467,000.
Which is a phenomenal amount of appreciation in just 36 months.
It really is. So their remaining mortgage balance at that point was $327,000.
Okay, so doing the math there.
Right. Here's what that means mathematically. They were suddenly sitting on $140,000 in home equity. On paper, their net worth had skyrocketed.
Right.
So their bank reaches out and offers HELAC up to $112,000. And the initial teaser rate was quoted as prime minus 0.25%.
And at the time, that calculated out to a remarkably low rate of about 2.75%.
Exactly. So the homeowner decides to draw $60,000. They used it to renovate a kitchen, consolidate some lingering credit card debt, and interestingly enough, they bought an investment piece of furniture from an auction house.
That auction house detail is such a classic behavioral economics moment. But hold on, just to pause for a second, we should clarify what that prime minus terminology actually means.
Good point.
The prime rate is essentially the baseline interest rate that banks use to price loans for their most creditworthy customers, and that prime rate moves in lockstep with the Federal Reserve.
Right.
When the Fed decides to raise interest rates to fight inflation, your variable HELOC rate goes up right along with it. It is entirely out of your control.
And that lack of control is where the trap snaps shut on our Atlanta homeowner. By the third quarter of 2023, the economic landscape shifted drastically.
Is it hard?
The prime rate hit 8.5%, that incredible 2.75% rate they started with. It jumped to 8.25%.
Wow.
And the math on that adjustment is just painful to look at. Their monthly payment started at a very manageable $275 a month.
Which feels like nothing.
Right. But after the rate hikes, that exact same loan demanded a payment of $1,034 a month. And this happened right as the Atlanta housing market plateaued.
That's the thing. Consider how a sudden 300% increase in a single monthly bill would affect your own household budget.
It would be devastating.
Imagine waking up and finding out your $275 car payment is suddenly over $1,000, but you don't get a new car. You just get the privilege of keeping the old one. That is the kind of budget disruption that forces families to make devastating choices.
Let's take a look at the historical timeline from the investigation to see how widespread this is. From 2020 to early 2022, the prime rate was sitting at a historically low 3.25%.
Basically free money.
Right. If you opened a HELOC during that window, it felt like someone was handing you nearly free money. But then we saw an unprecedented tightening cycle. The Fed raised rates 11 times in just 18 months.
Unbelievable.
That pushed the prime rate all the way to 8.5%. If we calculate the impact of that, a borrower who opened a $50,000 HELOC at 2.75% in 2021 saw their annual interest cost increase by nearly $2,750 by December 2023.
That is a massive stealth expense.
And fast forward to today, March 2026, and the prime has moderated just slightly to 7.5%. But effective HELOC rates are still sitting at a very pricey 7.25% to 8.9%.
What's fascinating here is the timing of this aggressive marketing push. I mean, you really have to question the underlying motives.
How so?
Well, banks are currently sitting on massive portfolios of traditional mortgages issued back in 2020 and 2021 that are locked in at 2.5 or 3%.
Right, the golden era of refinancing.
Exactly. But in today's economic environment, those old mortgages are basically a drag on their balance sheets. The banks are often paying higher interest to their savings account depositors than they are earning on those old mortgages.
Wait, so is this just predatory lending 2.0? Are banks actively trying to trap homeowners to balance their own books? Or is this just a standard financial product that happened to get caught in a volatile economic cycle?
This raises an important question, and the answer is nuanced. The banks aren't necessarily supervillains plotting in a boardroom.
Oh.
They are simply businesses responding to shifting incentives. They need a new product to drive revenue because nobody is going to voluntarily refinance a 3% mortgage today.
So HELOCs at 8 or 9% become the perfect life raft for a bank's bottom line.
Exactly. It is highly profitable interest income for them. When your relationship banker calls to excitedly tell you about your untapped equity, the product they are selling immensely benefits the bank at current rate levels.
Which means the burden of protection falls entirely on you, the consumer. You have to understand the mechanics of these loans before you sign on the dotted line.
You really do.
And the investigation does a brilliant job of outlining the specific structural risks involved. I was looking at this section in the data on the interest-only illusion, and it honestly blew my mind. Walk me through this 10-year draw period, because it sounds like a ticking time bomb for people's budgets.
It really is a delayed shock to the system. When you open a typical HELOC, the first decade is known as the draw period.
Right.
During these 10 years, you are usually only required to pay the interest on the money you borrow. Let's look at a generic example from the data. If you have a $60,000 balance at an 8.5% rate, your monthly interest-only payment is around $425.
So for 10 years, you pay that $425.
Yes. Psychologically, you normalize it. It becomes a fixed line item in your mind. But at month 121, year 10, the repayment period kicks in.
The repayment cliff.
Right. Suddenly, the bank requires you to pay the principal plus the interest. That $425 payment abruptly jumps to $520 a month. And if rates happen to tick up to 10% around that time, it could surge to $580.
And there's no gradual adjustment. You just wake up one month and the bill is fundamentally different.
Zero warning.
If our Atlanta homeowner hits their 10-year mark, they're already inflated a $30, $34 payment is going to get another massive structural hike added right on top of it.
Exactly the point. It catches people entirely off guard because 10 years is a long time. People change careers, have kids, retire, and then this massive new financial obligation drops out of the sky.
Okay, so the math on the rate hikes in the repayment cliff is terrifying on its own. But what happens if the housing market itself takes a hit? Because I'm looking at the National Association of Realtors data from the investigation, and the rapid appreciation party seems to be coming to an end in a lot of major metros.
If we connect this to the bigger picture, the 2026 real estate market is showing real signs of fatigue. The data is incredibly telling. As of late 2025, year-over-year appreciation in a former boomtown like Austin was just plus 0.3%.
Wow.
Phoenix was actually down 1.1%, and Nashville was up only 1.7%. The era of double-digit automatic equity growth has stalled out.
And here's what that means for your HELOC collateral. Let's define loan-to-value, or LTV, really quickly. It is basically the total amount of debt you have on the house compared to what the house is actually worth.
Right.
If you borrow heavily against your home, and then your local housing market drops by 8%, your equity buffer shrinks dramatically. You can quickly become equity poor.
That's the trick.
And because a HELZ is a secured loan, the stakes are exponentially higher than maxing out a credit card. Now, we need to be very precise here. In scenarios where a borrower falls behind on payments, based on observed patterns in the industry, the bank may initiate proceedings to pursue the collateral.
Exactly.
Individual risk depends on a lot of specific factors, but that underlying mechanism is always present.
That is the crucial distinction between unsecured and secured debt. If you default on a personal credit card, your credit score plummets and you get sent to collections. If you default on a loan secured by your house, the lender has a legal claim to the property itself.
Here's where it gets really interesting for me, because the investigation points out that the danger isn't just mathematical. It is heavily rooted in behavioral psychology. They call it the spending account loop.
Oh, I love this part.
Because the money is tied to an asset you already own, your brain plays a trick on you. It convinces you that a HELOC isn't actually debt.
It creates a powerful illusion of wealth. Research from the Federal Reserve Bank of Cleveland, which is cited in the piece, found that HELOC borrowers consistently overestimate their own repayment discipline and drastically underestimate the lifetime interest costs they will incur.
Think back to our Atlanta homeowner buying an expensive piece of furniture at an auction house with their HELOC. Their quote in the article is so revealing. They said, "It felt like I was just using money that was already mine."
That's the thing. It is incredibly easy to rationalize dropping $5,000 on a vintage couch when your banking app tells you that you have over $100,000 of available wealth just sitting there. You view it as personal savings rather than a leveraged variable rate loan.
That mindset shift is precisely the trap. But to be fair and objective here, we have to look at the other side of the coin. The investigation is very clear that HELOCs are not categorically evil.
No, not at all.
They are financial tools, and like any tool, they are just highly risky when used for the wrong job.
Exactly. Funding a luxury vacation, pouring money into volatile crypto assets, or converting unsecured credit card debt into secured home debt, those are scenarios where the risk profile is wildly out of balance.
But there are legitimate use cases where tapping home equity may be the appropriate move. The source outlines a few specific scenarios where this makes sense. The first is specific value-adding home improvements.
Right.
Say you have a failing roof or a dying HVAC system, and you plan to stay in the property the long term. Fixing those issues protects your asset. But the key detail the investigation notes is that you should evaluate that added value using an independent appraiser. You cannot just rely on an automated algorithmic estimate of the structural condition of your foundation.
That is a vital check and balance. Not all renovations provide a one-to-one return on investment.
The second legitimate use case is short-term bridge financing. This is for situations where you have a highly defined near-term cash inflow that is guaranteed. For example, if you have company stock vesting in 3 months, or you are finalizing the legal sale of a business, and you need immediate liquidity for a specific time-bounded purpose.
The operative word there being short-term. You are using the line of credit for a matter of months, not a decade.
And the third scenario is utilizing a HELOC as a true emergency reserve. Some financial planners suggest opening the line of credit but never actually drawing a single dollar from it. You just keep it dormant as a catastrophic backstop for absolute worst-case scenarios.
Even that strategy comes with significant caveats, though. It sounds like a perfect safety net, but you have to read the fine print. Banks often retain the right to freeze or reduce your credit line if your property value drops or if your credit score takes a hit.
Wow, so the bank can just turn off the tap?
Exactly. So the emergency fund you thought you had in your back pocket might be frozen by the bank at the exact moment the broader economy takes a downturn and you lose your job.
So, if a variable rate HELOC tied to the roof over your head is starting to sound a little too unpredictable, what else is out there? The investigation explores a few safer alternatives you should weigh before making a move.
Let's hear them.
First is the HELOAN, or a fixed-rate home equity loan. Unlike a line of credit, this gives you a lump sum up front at a locked interest rate. It completely eliminates the rate variability risk that caught our Atlanta homeowner. In the volatile economic environment of 2026, a lack of flexibility is actually a feature, not a bug.
It provides absolute predictability. You know exactly what your monthly payment is going to be on day 1, and you know what it will be on day 3,000.
Another great alternative is a standard personal loan. General rates for unsecured personal loans are running between 7% and 25%. For amounts under $40,000, the interest rate might be incredibly comparable to a modern HELOC.
And no collateral.
Right. And the massive glaring benefit here is that there is absolutely zero risk to your home. You can use aggregation platforms like Credible or LendingTree to compare personal loan rates in minutes without triggering a hard credit pull.
People often default to assuming the HELOC will be the cheapest money available, but depending on your personal credit profile, an unsecured loan might be highly competitive. And the psychological benefit of knowing your home isn't collateralized cannot be overstated.
And finally, for smaller necessary projects, there are FHA Title I loans. These are government-backed loans designed specifically for home improvements. For project amounts up to $7,500, they do not require you to put your home up as collateral.
So if you are listening to this right now and you are actively considering tapping your home equity, the Daily Fiscal lays out a phenomenal 5-step reality check. Consider this your mandatory homework before you sign anything.
Step 1 is calculating your true loan-to-value ratio. Don't guess. Get a real, localized appraisal.
Right. Divide your total debt, your primary mortgage, plus the maximum limit of the potential HELOC by that appraised value. If that resulting number is over 85%, you have virtually no buffer if local home prices experience a correction.
Think about our Atlanta homeowner. If they had run that true LTV calculation and stress tested it against a potential market softening, they might have realized how thin their margin of error actually was. And that leads right into step 2, running the repayment cliff scenario.
You have to do the ugly math. Take your planned HELOC balance and calculate what the monthly principal and interest payment would be if your variable rate increases by a full 2%. You have to stress test your own household budget.
Because if our Atlanta homeowner had done that back in 2022, they would have seen that $1,034 payment as a statistical possibility rather than a total surprise.
Exactly. Step 3 is to always compare those personal loan rates, just so you know what your unsecured options look like. Step 4 is critical. Demand to get the bank's freeze policy in writing. You need to know the exact metrics and conditions under which they can legally cut off your access to the funds.
And step 5 might be the most valuable piece of advice in the entire investigation.
Step 5 is to consult a fee-only fiduciary advisor. You can find accredited professionals through organizations like nappfa.org, and a consultation typically costs between $300 and $500.
And here's why that distinction matters.
Right. Unlike a product salesperson or your friendly neighborhood relationship banker, a fee-only fiduciary is legally obligated to act in your best interest. They do not earn a commission for selling you a loan. Their entire job is to look at your math and give you objective, unbiased analysis based purely on your financial reality.
So what does this all mean? When we distill this massive investigation down to its core elements, the lesson is clear. Before you make any decision that leverages the equity in your home, you must calculate your personal repayment cliff. You have to actively understand your worst-case payment scenario. And ideally, you should run those numbers past a fee-only fiduciary who has absolutely nothing to gain from your final decision.
I want to leave you with a final thought to mull over, something that challenges the current cultural narrative around home ownership. What if we collectively stopped looking at our homes as a revolving piggy bank or a convenient, oversized credit card?
That is a great question.
What if, instead, we treated our home equity as a completely untouchable, illiquid asset class until the day we actually retire or decide to sell the property? Imagine how that single foundational mindset shift could fundamentally change your long-term financial stability and dramatically reduce your daily stress.
That is a remarkably powerful way to reframe the conversation. Thank you so much for joining us on this deep dive. We hope this breakdown of the data and the psychology behind it has given you the exact tools you need to protect your hard-earned assets and make clear, informed decisions. Keep questioning the fine print, always run the worst-case numbers, and we will catch you on the next one.